Million-dollar homes are cracking first, that's the canary. We're seeing 40 to 50% list-to-close collapses in markets everyone called untouchable. Scottsdale, Miami Beach, Park City, Austin's trophy suburbs, and San Francisco. The data's brutal. Inventory is soaring, days on market doubling, absorption stalling, and sellers capitulating. Equity isn't drifting, it's evaporating. Refinancing blocked by appraisal gaps and jumbo scrutiny. One of these 5 doesn't belong. Spot the outlier. Stay to the end for a tight risk checklist and safer plays you can act on now. We start with the beach boom that turned into a bust, then move inland where liquidity dies. If you want the real data each week, subscribe to American Affordability Atlas so you don't miss the next move. We pulled luxury tier signals straight from Redfin and Zillow across the last 6 to 12 months, then benchmarked against 2019 baselines and 2021 peaks. Inclusion required documented 40 to 50% resets from initial list to close price, or from peak valuations to today's accepted offers. We focused on 5 hard metrics: list to close delta, serial price cuts, days on market, months of supply, and absorption rate deterioration. We filtered out one-off outliers and leaned on clusters, multiple listings in the same segment, showing the same collapse pattern. You'll hear brief buyer and seller anecdotes to validate the data, not replace it. Why luxury leads? Investor-heavy, discretionary, and suffocating carrying costs, insurance, taxes, and HOA assessments turned patience into forced discounting fast. City number 5, Scottsdale, Arizona. Scottsdale's luxury tier became a magnet for flippers and second home speculators. The story was easy money and endless demand, but in 2025, that power is collapsing. Redfin shows $1 million plus inventory surging while days on market have doubled versus a year ago. The biggest red flag, the share of listings with price cuts has climbed relentlessly, with a growing slice taking second and third reductions just to get showings. Zillow's luxury tier estimates are rolling over. Comps that anchored 2022 highs are now breaking, with accepted offers clearing well under prior peaks. The pattern here is vicious. High carrying costs collide with rate shock, and investors who stretched at 3% now face a different math entirely. Anecdote: a cash buyer walked after getting real insurance quotes and updated HOA projections on a guard-gated subdivision. Premiums up, reserves underfunded, special assessment risk flagged. The seller had already cut 28% over 3 months. They relisted 18% lower again and finally closed at nearly half off the original 2024. Ask, that's liquidity evaporating in slow motion. Notice how this one reveals the trap. Scottsdale isn't short of wealth. It's short of buyers willing to absorb the new monthly burn, higher insurance, inflated HOA, rising taxes on reassessed values. Meanwhile, investor exit accelerates. When investment inventory hits the market together, absorption collapses. The result, comps reset lower across the segment, not just for one unlucky seller. From desert sizzle to a freeze, now the coast starts cracking, where carrying costs don't just sting, they suffocate. City number 4, Miami Beach, Florida prestige condos and waterfront mansions rode the pandemic surge to unimaginable asks. But in 2025, the glamour coast is bleeding. Redfin's luxury days on market have jumped sharply, and months of supply in prime Miami Beach zips keep swelling. The most alarming signal is the depth of price reductions, serial cuts that would have been unthinkable 2 years ago. Zillow's $1 million plus cohort shows repeated trimming, with a cluster of closings 45 to 55% below original list. The reason? Insurance and HOA pain, not just rates. Premiums are exploding. Older buildings are pushing special assessments that turn ownership into a financial chokehold. Anecdote: an out-of-state buyer fell in love with a high-floor ocean unit. Inspection came back fine. But 3 insurance quotes later, they backed out, annual premium triple what the listing agent estimated. The unit relisted 52% lower than the first ask, and finally moved after months of zero traction. That's not a comp, that's a capitulation. The pattern here is ruthless. Carrying cost shock blows up budgets. Sellers who anchored to 2022 pricing have to swallow reality when months of supply climbs, and all-cash whales demand brutal discounts to compensate for ongoing costs and building risk. And now in 2025, the boom has turned into a bust for properties with assessments in the pipeline or rising flood and wind premiums. If the glamour coast is bleeding, the mountain trophies are next, where seasons stretch holding costs, vacancy crushes the spreadsheet, and discretionary demand disappears overnight. City number 3, Park City. Pandemic migration turned ski towns into speculative casinos, and Park City was the table everyone crowded. Now it's quiet. Redfin shows luxury months of supply spiking while days on market stretch across seasons. Listings that expected spring and summer to save them are still sitting through fall. The result, sellers chase buyers with deeper and deeper cuts. Zillow comps in the $1.8 million to $3 million segment are retracing hard. Price revisions keep stacking, and the second and third cuts are where deals finally happen. Investors who counted on short-term rentals to subsidize costs are finding shoulder seasons and market saturation, wiping out returns. Anecdotes: a slopeside seller priced aspirationally for 2024. Winter passed with 0 offers. A buyer came in demanding 48% off, citing updated comps, soft occupancy, and rising insurance. After another dead month and a painful carrying cost tally, taxes, HOA, maintenance, the seller accepted. That's a trophy home becoming an illiquid liability. Remember this detail: thin buyer pools amplify every inventory spike. Luxury ski homes don't have elastic demand. They have a small club of buyers who can wait. Meanwhile, the ownership math gets worse every month. The pattern is clear. Seasonal costs plus softer rental income equals forced repricing. This next one takes it further because Austin's trophy suburbs layered tech euphoria on top of builder oversupply. When appraisals miss and investor liquidations hit at the same time, equity isn't chipped, it's amputated. City number 2, Austin, Texas. From 2020 to 2022, Austin's West Side trophies were minted like tech stock options. Now in 2025, that euphoria is unwinding. Redfin shows luxury inventory ballooning across Lakeway and Westlake while absorption is collapsing. Days on market have stretched deep past the 90-day mark, and the share of listings with multiple price cuts keeps climbing. Zillow's $1 million tier is retracing toward pre-boom comps. What's crazy is how builder incentives are hiding the damage. 6-figure rate buydowns look like perks, but they function as price. When you normalize for credits and closing cost fireworks, effective resets approach 40 to 50% from first list to final net. Anecdote: a modern new build in Westlake launched high, expecting a cash tech buyer. Appraisal missed by 30%. Financing unraveled. After 120 plus days and 3 public reductions, the seller accepted a contract that netted 51%, below the original ask once you account for credits and a rate buydown. That's not soft landing, that's a cliff. The pattern here is ruthless. Appraisal gaps collide with investor liquidations and builder overhang. Each forced sale becomes a comp. Lenders tighten, jumbo scrutiny raises. Buyers smell blood and widen the discount. And now in 2025, the boom has turned into a bust for trophy zips, where taxes are expensive, schools are great, but the buyer pool is shrinking. And the epicenter, the most brutal luxury reset in America, isn't a Sunbelt suburb. It's the flagship coastal market everyone thought was invincible. City number 1, San Francisco, California. San Francisco's wealth engine stalled. Remote work siphoned demand. Downtown slumps. And now in 2025, prestige is collapsing. Redfin's luxury days on market sit at cycle highs, with months of supply elevated across prime districts. Sellers used to list, wait a weekend, and choose. That power is gone. Zillow's $1 million tier is rolling over hard. The depth of list-to-close haircuts on view homes and renovated Victorians is staggering. Older stock faces seismic retrofit costs. Carrying taxes are heavy. Maintenance drags relentlessly. Buyers demand discounts to compensate for risk and long hold times. Anecdote: a pre-IPO engineer bought at peak, couldn't exit, became a reluctant landlord. 2 failed listings later, they capitulated, closing at a 53% haircut to the original 2021 ask after credits to cover retrofit escrow and roof work. That's equity evaporating under the weight of costs and a thinner buyer pool. The biggest red flag: investor activity is fading. Tech equity isn't rescuing comps. International demand is selective. Meanwhile, inventory accumulates. Each month that passes, more sellers test the market and the discount deepens. The pattern: demand erosion plus cost gravity equals prestige discounting. But here's the deeper truth. Luxury cracks first because it's the most fragile when carrying costs surge and the buyer base shrinks. And that's the blueprint spreading nationwide. Luxury is investor heavy and discretionary. When returns flip negative, they sell first. Insurance, taxes, HOA fees, assessments, carrying cost shock shortens holding patience. The buyer pool is thin, so each new listing spikes months of supply. Financing friction intensifies. Appraisal gaps widen, jumbo rates stay high, underwriting gets stricter. One capitulation sale resets comps, which pushes appraisals lower, which triggers more price cuts. It's a chain reaction. Notice how every market we covered shares the same ingredients: higher fixed costs, slower absorption, and sellers anchored to yesterday's prices. That's why the top tier collapses first and drags the rest with it. Don't anchor to 2021. Price off today's comps minus another 10 to 15%. Track Redfin's price cut share, days on market, and months of supply weekly. When all three rise together, risk is rising. Verify insurance quotes, HOA reserves, and pending assessments before you write an offer. Demand appraisal contingencies and seller credits. Treat builder buydowns as price. Prefer liquid submarkets, stable schools, low HOA exposure, low insurance zones, and diversified employment. If you're listing, front-load reality, price under stale comps, stage, and pre-inspect to reduce renegotiation leverage. Liquidity now beats holding out for a ghost buyer. Here's the truth. Luxury leads the downturn because costs surge while buyers thin out, and that crushes comps fast. If you want weekly data-backed breakdowns, subscribe. Share this with anyone house hunting near these markets, and watch our next video so you don't get trapped buying the peak of a dead cat bounce.